Smart investors keep a tab on market valuations as they know that market valuations are an important determinant of returns. On this channel, we make it easy for you to do so. From time to time, we assess market valuations so that you can know if the market is expensive or cheap or reasonably valued. This can in turn help you realign your portfolio and recalibrate your return expectations. We last assessed market valuations in March 2025. At that time, the markets had corrected from their September 2024 peak, so we wanted to check if the market had turned cheap. Indeed, there were signs of lower valuations in certain pockets. But since then, there has been a sharp recovery. The BSE 500 has clocked gains of 17% since February 28, 2025, and it is just about 5% shy from its all-time high of 38,620, last seen in September 2024. So does it mean that the markets have turned expensive again and you should be cautious? That's what we'll try to find out in this video. Hello and welcome to ET Money's YouTube channel. Like last time, we'll use certain valuation measures to assess market valuations. But in place of 4 metrics, we'll use 5 metrics this time. Price to book ratio, dividend yield, cyclically adjusted PE ratio, market cap to GDP, bond equity earnings yield. So after watching this video, you'll have a thorough idea of the current market valuations, that too from multiple perspectives. But for that, you must watch this video until the end. This video belongs to our playlist on market trends. If you would like to watch similar videos, you can explore it. The link is in the description. So let's start with the first valuation metric. In the previous edition of this video, we discussed why we did not use the price to earnings or the PE ratio to assess valuations. Let me restate that logic. The PE ratio depends on earnings, which can be volatile. In good economic times, earnings can explode, and in bad times, they can sink. That can distort the valuation picture. Secondly, earnings can be influenced by non-operating factors, so they don't always act as a proxy for business growth. In a quarterly result update video, we have frequently seen cases where the profits are higher, but operating margins have slipped. In other words, the growth in profits was not due to business performance but due to other factors such as other income, one-off gains, a fall in depreciation or interest or tax, etc. Hence, we decided not to use the PE ratio in its classic form. But we'll still use a modified variant of the PE ratio. More on it later in this video. If you would like to know more about the pitfalls of the PE ratio and what alternative valuation metrics you can choose, you can check our latest video on this topic. The link is in the description. But why price to book ratio or PB ratio? The book value or net worth is much steadier than earnings. Hence, we decided to use the price to book or the PB ratio. Now, the PB ratio is calculated by dividing the stock price by the book value per share. At the index level, it is calculated by dividing the total market cap of the index by total book value of the index constituents. Let's check the current PB of various market cap segments vis-a-vis their historical medians across multiple time horizons. All 3 market cap segments are currently expensive in historical terms and across time frames if we go by their premiums to the median values. The small cap segment, as represented by BSE 250 small cap index, is especially overheated, with its premium to median ranging from 35% to 80% across time frames. Even in February 2025, small caps were not cheap in spite of the fall. At that time, the premium to the median PB ranged from 20% to 45%. So over the last couple of months, they have turned even dearer. A similar observation can be made for mid caps too, although the revision in their valuation premium is not as steep. Now, from a premium of 30% to 46% in February 2025, they have become more expensive by 27% to 57%. So as far as the 3-year picture is concerned, they are slightly cheaper now as compared to where they were in February 2025. Finally, at a premium of 13% to 36%, the large cap segment is the least expensive of all market caps. Still, as compared to their February premiums of 8% to 26%, They have graduated in valuation as well. Now let's check the valuations of these three segments in terms of their dividend yield now. But before that, an important update. You can now get cash to enjoy your present while staying invested for your future with loans against mutual funds on the ET Money app. The interest rate is just 10.75% per annum and there is no fixed EMI. Pay interest monthly and repay the principal amount whenever it is convenient for you. Plus, there is no need for a CIBIL score. So go ahead, check your eligible limit on the ET Money app, and there is more. For the next 3 months, any withdrawal you do, you'll get a special rate of 9.99% per annum. So go for it now. Now, dividend yield is a new valuation metric that we'll be using in our valuations analysis. So let's first understand how it functions. Dividend yield is derived by dividing the dividend per share by the stock price. At the index level, it is the weighted average of the dividend yields of individual stocks comprising the index. If the current dividend yield is below the historical median, that indicates an overvalued market. Yes, overvalued and not undervalued, because it implies that you are getting less in dividends, possibly owing to elevated market levels. Similarly, if the dividend yield is at a premium to its historical median, that indicates an undervalued market. So let's take a look at the current dividend yields of the three BSE indices that we just saw. As far as large caps are concerned, as represented by the BSE 100, the current dividend yield ranges from a discount of 4.7% to a premium of 2.5% to the median values. A slight premium over a 5-year period indicates that they are cheap at the moment from that perspective. This premium was even greater in February 2025 and stood at 6.8%. Coming to mid caps, the discount ranges from 13% to 18%. This suggests that they are expensive at the moment. But as we saw in the case of the PB ratio, the revision in valuations is not very steep as compared to their discount of 9% to 18% in February 2025. Finally, for small caps, the current discount ranges from 27% to 37%. Now that's a sharp jump from 12% to 18% levels seen in February 2025. Overall, in terms of dividend yield, small caps are quite expensive. Large caps are reasonably valued and mid caps lie in the middle. Let's now move to the next valuation metric. As I mentioned briefly a little while ago, we would be using a modified variant of the PE ratio. That modified variant is the cyclically adjusted PE ratio or the CAPE ratio. Let me first explain what it is. As we discussed a short while ago, the classic PE ratio uses earnings which can be volatile due to business and sectoral cycles. The CAPE ratio addresses this volatility in earnings by averaging the inflation-adjusted earnings over a 10-year period. Now, this helps smooth out short-term fluctuations and get a more accurate picture of valuations. The CAPE ratio is also called the Shiller PE ratio as it was introduced by Professor Robert Shiller in 1988. Joshi Jacob and Rajan Raju of IIM Ahmedabad have calculated the CAPE ratio of the Nifty 500 based on 5, 7 and 10-year business cycles. Let's take a look at where the Nifty 500's CAPE stands with respect to its median. Now, with respect to the 10-year business cycle, the CAPE is currently at a premium of 57% to the median of 26.5. This signals an overvalued market. In February 2025, this premium had come down to 48% but has since inched up. As far as the 7-year business cycle is concerned, the CAPE is at a premium of 44% to the median of 26.3. This premium is higher by about 6 percentage points than that in February 2025. Finally, if we check the CAPE for the 5-year business cycle, the current CAPE is at a premium of 36% to the median of 24.6. This is just over 2 percentage points higher than the premium in February 2025. Thus, across all CAPE time horizons, the Nifty 500 is more expensive than the median. Let's now talk about the next valuation metric, market cap to GDP. But before that, do subscribe to this channel if you aren't already a subscriber, and don't forget to press the bell icon so that you never miss a video from us. The market cap to GDP ratio is also called the Buffett indicator, as Warren Buffett personally likes this valuation measure. So market cap to GDP ratio is equal to total market cap of all listed companies divided by total GDP. Now, when the market cap of all listed companies is more than the GDP, the market is said to be overvalued and vice versa. The total market cap of all listed companies in India on the BSE currently stands at 459 lakh crore or $5.3 trillion. India's GDP is 331 lakh crore or $3.8 trillion. This gives us the current market cap to GDP ratio as 139%, which means that the market cap of all the listed companies is more than the country's GDP. That suggests overvaluation. But it is also sensible to assess the valuations vis-a-vis the historic median. So the median value stands at 110%. So the current value of 139% is at a premium to it. So both absolutely and in relative terms, the market seems to be overvalued in terms of the market cap to GDP ratio. In February 2025, market cap to GDP was lower at 110% and was near the median of 108% at that time. Now the gap between the median and the current value has widened quite a bit. This brings us to the last metric, the bond equity earnings yield or the BEAR ratio. To calculate the BEAR ratio, the yield or the expected return from a bond is divided by the market's earnings yield. The earnings yield is nothing but the inverse of the PE ratio. Put simply, if the market were a bond, the earnings yield tells you what returns would you make from it. So comparing the bond yield with the market's earnings yield can tell us about their relative attractiveness. Theoretically speaking, if the BEAR ratio is more than 1, that suggests that bond or fixed income is more attractive now. If the BEAR ratio is less than 1, that suggests stocks are more attractive now. However, in real life, that's seldom the case. In the case of Indian markets, the BEAR ratio has seldom fallen below 1. That's why it is more practical to check the deviation of the BEAR ratio from its historic median. So if the BEAR ratio is above the median, that indicates an overvalued market and vice versa. As a proxy for the market, we have considered the BSE 500. For bond yields, we have used the 10-year GSEC yield. Now, as against the 10-year median of 1.71, the current BEAR ratio stands at 1.61. That's a discount of about 9%. So, as per this measure, the market is currently at a discount to its historical valuations. But it's noteworthy that this discount has shrunk from 16% in February. Still, that's some good news for equity investors. But if you are a risk-averse investor who prefers fixed income, you can find attractive FD options on the ET Money app that can give you returns of up to 8.4% per annum at a time when interest rates are falling in the market. Do explore them now. Now let's summarize the results from the 5 indicators in the concluding section of this video so that you can get a comprehensive picture of market valuations. So in this video, we assessed market valuations across 5 valuation metrics: PB, dividend yield, CAPE, market cap to GDP, and the BEAR ratio. The summary of this analysis is on your screen. In all but 2 cases, the markets appear to be overvalued at the moment. That may indicate a correction is in the offing. With the kicking in of the Q1 results season, any disappointment on the results front can result in a steep fall in the market. But one important caveat here. While it's good to check historic valuations, market movements are more of a function of future expectations rather than past valuation multiples. So do take into account growth expectations as well. For instance, as a basket, mid and small caps are quite pricey at the moment with respect to their median valuations. But the same median would have looked pricey in 2007. In other words, the god of growth can set many things right. Finally, what should be your investment approach amid the current market conditions? So asset allocation is the ultimate solution to dealing with any market conditions. Within asset allocation, dynamic asset allocation can actually help you not just survive but thrive in any market phase. ET Money offers you innovative solutions for dynamic asset allocation on its app. Do explore them today. And that's all I had for you today. Hope you found this analysis useful. Do like, share, and comment in large numbers so that this video reaches a wider audience. I'll be back soon with another insightful video. Until then.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.